All right. Hey guys, welcome. It's good to be back with you. And as always, I love putting on the state of the market update. Let me pull that up for you. And we're going to jump right in. Let me just see if I can make my camera a slight bit bigger. And there you go. All right, great. No, actually, I'm going to go back to where I just was a moment ago. Here you go. In the meantime, if you can see me and hear me, it'd be great for you to just let me know in the chat. That way I know everything is coming through, audio, and there we go, a little slightly bigger camera. Okay, all right, good. And it looks like everything's coming through perfectly fine. So I will jump right in. There's a lot of changes, especially in the local marketplace, especially with pricing, a really interesting look. We're going to spend more time today on the local statistics, local look at what's happening with the marketplace in San Diego County. I've been doing a lot of macro look at what's happening nationally and all the moves the Fed was making. But right now, we're going to spend a little bit more time really looking locally. Very quickly, if this is your first time with me here, I'm Dan Beer Home Team. We've sold over $3 billion, not the brokerage, just literally our team, Beer Home Team. And San Diego County real estate over the last 17 years. And in fact, a month from now, we'll be hitting our 18th anniversary. So that's landed us on the Wall Street Journal top 50 teams in the country. Inc. 5000's recognized us now 4 times on their list. San Diego Business Journal, best places to work. San Diego Business Journal, top producing team in San Diego County. Expert guests on ABC, NBC, Fox, etc. And I always give you the family update. So there's our trip to Cabo, a lot of these photos. And then you'll see on the top right, that's actually Mary and Laura that I work with. We just came back from Indianapolis, the EOS conference, which is the operating system that we run the business on. And it's an amazing system for small businesses to just be on the same page, make great progress. So we spent some time there, and that's the War Memorial in Indianapolis. So let's jump right in. I want to take a look at the local market statistics. And again, I always try to give you not what the news says, not what the headlines are built for. And we're going to talk about headlines because there's especially something happening right now that takes place on May 1st that is just, it's built to scare. And the reality is very different than what's being told, even though it's of course rooted in a shred of truth. And much like that, the headlines are just, we have to just recognize the news is in the business of getting eyeballs, getting clicks, okay? Now, I'm not going to spin anything positive or negative. I just want you to know exactly what it is, and then you can make decisions. So when we're looking here at new listings, down 41% still this past March from a year ago. Okay, so we have the March complete numbers, and it's down from a year ago, still down 41% in terms of new properties coming to the market, which has caused pending sales to be down 34% and closed sales down 32%. Okay, so that story has very much continued, but I want you to look at the bar chart, not just the percentages, because this is where the news will take advantage of the consumer that is less educated than what we spend time doing here. They'll say, hey, new listings down, pendings down, closings down, the real estate market's falling apart. They, for whatever reason, would like us to believe we're in some kind of market crisis. But then if you actually zoom in and look at the bar chart, you'll see that for 3 months in a row now, closings have grown. For 3 months in a row now, pendings have increased. So really important that you notice that, take a look at that. Next, you go to median sales price. Okay, so median sales price, average sales price, let's start with median. It's at $825,000. Okay, so it's down 2.4% from a year ago in the same month. Having said that, go look at the chart, and it's now been 3 consecutive months of growth. Okay, of growing median sales prices here in San Diego County. And when you look at the average, it's going to show that we're down 4% from a year ago in March, which is true. Now, remember something. Let me slow down. March a year ago, interest rates were still around 3%. They had not shifted yet, which right now we're at more than double what they were then. So, are we down from a year ago in March? The answer is yes, we absolutely are. Is that a bubble? Is that crazy? Is that, the world fell apart in real estate? Not at all. As we've discussed in a lot of these market updates, there's a lot of reasons why real estate has always outperformed in any market, economic turmoil, recession, which we're not officially in, other than the 2008, 2009 recession, which is when it was caused by real estate. But zooming back in over here, let me jump down to days on market. This is extremely significant. Days on market have doubled from a year ago. Okay, so March of 2022, average days on market, 18, today 36. And so what that implies is that right now, and I'm going to take you through a math equation at the end, I'll make it really simple. Right now, there is actually a way to use the higher interest rates to your negotiating advantage and actually come out with an absolute provable, mathematically provable net gain. And I'll walk you through that. If you are selling your home and you're talking to your buddy that sold, right, March, April, February, January of a year ago, different planet. Okay, so it is important that expectations to that degree are adjusted. Homes for sale still down 9.5% from what was going on there. And if you look at the bar chart, they've only continued to decrease, and supply has just, it's up. Sure. It's up 1.1%. It's up at 1.1 months versus 0.8 months a year ago. So that is a 37% increase, a number that the news likes to use to create fear and panic, but it's up from 0.8 to 1.1. Okay, so there's really not a ton of supply increase there whatsoever. And it's interesting if you look at the bar chart, we're higher than we were a year ago, but we've actually been dropping in supply for the last many months, as you can see there in the bar chart. So San Diego leading this is really, really interesting. This comes from CoreLogic. And this is what you don't really see here. And I wonder, why is it not published anywhere other than by the big data companies? So CoreLogic now has shown us that San Diego's leading the country in month-over-month appreciation right now. San Diego, again, let me say that, because by the way, it was also one of the biggest losers of market value in the tougher months when we started to get all the interest rate shock. But now it's actually been leading the month since January to February in month-over-month appreciation. So really significant to note. Really a quick visit here on mortgage rate affordability. Mortgage rates and affordability, 30-year fixed mortgage payments for $900,000 home with 20% down payment. We show you this equation every month, but we update the number. Today that'd be about a 6.375% mortgage rate, which would be a payment of $4,491. A year ago, that same payment of 3% would have been at $2,951. So that's a difference of $1,540. And it's that difference that we are really watching for it to condense. And it actually is, it really tells the story of why there is so little inventory. When you're wondering why is nothing coming to the market, well, it's because when the Federal Reserve decided to artificially bring down interest rates by buying so many mortgage-backed securities, creating such a gigantic market for them that rates compressed, well, all of a sudden, there were hundreds of thousands of households across the country locked into these dramatically low rates. And that person, if they make the move, is going to be facing a payment increase, even if they stayed at the same value home, right? So that is the main reason why two things are happening. A is our inventory is locked up to some degree, and B, a lot of the moves are still happening out of state to try to, because those are people that say, well, I don't want the big house anymore, or I want a bigger home now, right? Depending on what life stage you're at. But if I make the move, I will have a much higher payment than I'm comfortable with. If I stay here, let me find a place I can go to where that won't be the case. So that's the number we're waiting to move on. We need the interest rate number to drop down. And I don't think we need it to drop down to 3%, but I do believe if once we get into the fives, you'll start to see inventory return to the marketplace. And of course, as we've gone over month here, that will not happen in any kind of significant way until inflation is provably lower. And of course, we have all the reasons we've been discussing on why we think that will happen. And by the way, I just should mention, we post these all to our YouTube channel, which is San Diego Neighborhoods. That's our YouTube channel. You can just search my name, YouTube, and you'll find it. And we post every one of these market updates there if you want to go back and see anything we've discussed previously. Now, let's go here. Really important. This is extremely important. This is the big news scare headline. And it is about, if you've seen this one, have you seen the one about how high FICO score borrowers, so people with good credit, how they're being penalized with higher fees versus those people with low scores who are being rewarded for their low score. And so if you've seen those headlines around or heard people talking about this at a party, look, this is where it's rooted in a shred of truth, but completely misinterpreted and used as political capital. So let's talk about what's really happening. And first, let's clear the air on something. If you have a 740 FICO score versus somebody borrowing on that same home with the same interest rate, with the same down payment against someone, but that person with like a 650 credit score, that 650 credit score borrower will pay higher fees, absolutely, than the person with the higher credit score. Okay, so we are not in a world in which the high credit score pays a higher fee than low credit score. And it's really gotten to the point where it's so crazy. People are talking about ruining their own credit to get better mortgages. Okay, don't go do that. It doesn't work that way. You will not, you won't like the result. What is happening is that there's always been, and by the way, this number moves. It moves. It always has moved. It's always moved on a consistent basis. It's based on what's called LLPAs, or loan level price adjustments, okay? And that's imposed by Fannie Mae and Freddie Mac, the agencies these two entities that guarantee a vast majority of new mortgages, okay? That's who they are. And the LLPAs are based on loan features such as your credit score, loan to value, occupancy, some other components, but mostly your down payment and FICO. And what's happening is there's always been a world in which the relationship between the two shifts. Okay, there's always been, I'll show you this chart in a moment, but there's always been this relationship between the gap, okay, between how inexpensive the fee is and how expensive the fee is, right? Inexpensive for high score, inexpensive for low score. There's always been a gap between the two, and that gap has always shifted. Always happened. And right now they just simply did another shift, even though it was a larger shift than normal. But this chart shows us what the shift actually has caused, what it's actually created. And if you have any questions, you make sure you throw them in the chat. I always make sure to answer 100% of questions that are asked here. So this chart shows us, let me show you how to read it so that you actually understand what's happening here. Again, you have 760 FICO. And you're putting, let's call it 20% down, your fees are absolutely lower than someone with a 660, 680, 700 FICO. You are, okay, so we're not in a world we're not in an upside down world. What is happening, however, is you look at the chart, let's just go over here to the 760 line. So that's this second row, and to where it says 75 to 80% down payment. So let's take someone with a not down payment, loan to value. Meaning, let's take someone with a 20% down payment, which would be this 75.01 to 80%, right? The 80%, that's a 20% down payment. Well, if you had a 760 FICO, you have now that your reduced fee structure by Fannie Mae, you now have a 0.125% higher fee than you did previously. And if you have let's call it a 680 FICO score. If you have a 680 FICO score, you see how it says 0. Your FICO score, your fees on that same 20% down loan have not moved. So the gap between the two has compressed. Okay, the gap between the two is compressed, yet you still have a better fee structure if you have a better FICO score. Okay, I can't stress that enough, because you're going to see everybody you turn on the news and everyone's taking advantage of how little time or interest they actually have in explaining this in detail, and how they just know it's going to get you to share the link with your friends and panic and, click, which makes them money. Let's do another example. Let's go to a world in which you had 25% down. So that's that 70 to 75% column. Well, if you had a 760 FICO, your fees haven't even moved at all. Nothing, 0. But if you had a 660 FICO, your fees are now 0.875% better. Okay. or less than they were before, but but your fee is still much larger than the person with better FICO. If that's not 100% clear, and I hope I've been clear in it, it's a thing that's so much easier to explain in person, but hopefully that makes sense. Okay, the recap of it is high credit score is still better, lower fee. Low credit score is still worse, higher fee, but the gap between the two is just simply compressed. All right, moving on from that, here's the deal for San Diego. Well, in San Diego, this doesn't even apply to loans above $977,500, okay, because that's the San Diego non-conforming loan amount. And so if your loan amount, let's say you're buying a $1.5 million house, or you're buying a $2 million house, or $1.4 million house, and the loan is above, if the loan is more than $977,500, nothing we just discussed even applies. So a lot of San Diego loans don't even fall under what we just talked about. And so that gap it's just not in play. Okay. Like you do not have any of what we just discussed. Banking update really quickly, because these are the other headlines that you'll see. First Republic, okay, and the banking crisis, and you see First Republic, is it going to be the third bank to fall or not? Is it in trouble, et cetera? So it does look to be fairly stabilized. And of course, it got a $30 billion infusion from some of the larger banks. But they have now reported that, and you might have actually have seen in the recent earnings report, their stock dropped by about 25% in a single day just very recently. And I'm not talking about the big drop that they had previously. And the reason why is they lost $100 billion in deposits. And in fact, the banking industry as a whole had a $563 billion total drawdown. Okay, so $563 billion were pulled out of banks. So what does that mean? Why do we care? Why are we talking about this in our San Diego real estate market update? Because what it means is there's less liquidity in the marketplace, less cash in the market, right? Less borrowing power. There will be less loans. Lending will be tighter, and especially from those medium-sized kind of, more regional banks, the local banks. And why does that matter? The reason it really absolutely matters is because a lot of money will go back to the big banks that can't, too big to fail banks. And so I don't, we're not at least seeing yet any kind of lending crunch from the big banks, but the big banks don't understand the local markets as well as the local small banks, regional banks do. And so that matters because that person, that borrower without a perfect credit score and a perfect file, but asking to borrow money against a business plan, a real estate deal that makes absolute perfect sense and that the local banker can understand and lend against, that's what small regional banks are for. But they don't have the cash to the degree that they had previously. And so that person doesn't have the opportunity to get that loan, that it's harder to get the loan. There's less of that available. And so kind of that middle, it's basically, call it the middle class, will feel that to a much larger degree than the people that can go out to the big banks, get the big loans, have a perfect file. So that's a pretty significant, it's a significant thing that we're watching happen. And we're seeing that it's like that in combination with the fact that savings rates have dropped from 13.4% in 2021 to now 4.6%. So savings rates are down, and these just become those little things that start to erode. And we're still waiting for official recession announcement. But what will it mean to real estate? Well, in real estate, what a recession will mean very likely will be lower interest rates, which will actually keep real estate happy compared to other areas of the economy. Remember, we've reviewed in the past that recessions are devastating in that you have job loss, but from a pure real estate standpoint, okay, I'm not being insensitive. I'm just saying that's my job, is how do we interpret this from a real estate standpoint? Well, a 1% increase in unemployment equals about a million lost jobs, okay, roughly. but a 1% decrease in interest rates equals about 5 million borrowers now qualified that weren't qualified before. So that's why the real estate market's always been resilient in recessions. We just talked about this. It creates this lending crunch. And let's talk about what we think the Fed will do next as we watch interest rates. So it's funny, you know, from when we were first reporting this months back, and we were just like, okay, well, they're expected to increase and increase and watch how different this is. Current target rate is 475 to 500 basis points, or in other words, 4.75 to 5%. That's the Fed funds rate. Again, the rate at which the Fed lends money to banks, and then eventually it gets to us through markups. Well, on May 3rd, the Fed is meeting. And on May 3rd, at the May 3rd Fed meeting, it is predicted that rates will increase another quarter point. Okay, so you can see they will go to 500 to 525. You can see that number at the bottom of this big blue column. So this is Wall Street's bet. Wall Street's bet, what's priced into the current markets, is that the Fed will do a quarter point increase on May 2nd. But what's really interesting is you go to the June 14th meeting, and Wall Street is betting heavily. Okay, heavy bet that it stays put, that we topped out. So basically they're saying that they will not go higher than what they were in May, that May is the top of the interest rate market as far as the Fed funds market goes. And so that is a fairly significant thing to look at, because we haven't really seen a chart that looks like this at all in this entire time. Let me bump my head out of the way here in the screen so you could see 70% of Wall Street is betting on that. And then a little bet, the next biggest bet is that it actually decreases in June. And then, of course, a tiny little bet that it increases, but the probability of that is very, very low. And if we go out now to July, the July meeting, Wall Street's actually betting for the July meeting that you would have, again, that we would stay put, but 36%. Now it's a lot more. It's almost almost split, in that people think that at that point they'll actually start to decrease the Fed funds rate, which is just an interesting thing to watch. And here I want to give you a reminder of why this is the moment. Okay. This right now is the moment. People are trying to time the market. People say, oh, I want to wait till it's down, till the rates change, till that changes, till I find the bottom. I have to repeat this from a month ago, because it is just critical that we truly understand. First of all, very few people, there will be a tiny shred of a percentage of people who will make their purchase at the bottom of the market. And you can't know that you did it until it's already done. It's a luck thing. It can't happen. But what does happen, absolutely, is that when you buy previous to that bottom, okay, previous to that bottom, when you buy there, then, and keep in mind, San Diego, it might be there already. It's hard to exactly say. We need another month or two of data, but you can still buy in an environment where there's sellers that have fear. You can still buy in an environment where you get a better deal, where you negotiate more repairs, where you get better terms, where you might get some closing costs. You can still negotiate in that environment in exchange for the cost. And it's a real cost. I'll show you the math in a moment, of the higher interest rate. And once those interest rates do bottom out and the market starts getting flooded with more buyer activity, number one is seller confidence grows. Your ability to negotiate drops. There's more multiple offers, and you end up paying for more. You end up, in other words, being happy and proud of yourself for having the lower rate, but you're paying a whole bunch. And then all of a sudden you realize that the people that paid less are just simply refinancing into the rate you got. And it's important that we remember this. When the market bottomed out in 2012, look at the rate at which it was dropping, not very dramatic, from 2011 to 2012 as it found the bottom. But look at the rate at which it grew, 8%. 8%. Move my head out of the way here a second time. Let's go to lower left. There we go. 8% drop, increase in appreciation from 2013 there, 2012, 2013. So huge. And inventory levels were at 2.4 million homes on the market at the time. Right now, they're only at 980,000. So here's the question for you. Do we think that with inventory so much lower than it was then, and they had 8% appreciation, do we think we're going to get more appreciation, the same or less? There's a really strong argument for more. But let's go with a math illustration of what happens if we get less, just 3%. $1 million home, $800,000 mortgage. Okay, rates about at 1% higher than what they'd be later. Great. That means at $384 more per month, $4,600 more per year for that house. But you bought it. You see the opportunity? Can you negotiate a 2% discount in this market environment? So maybe you bought that home for $20,000 less. And then when that market does find that bottom and that stronger bounce happens that we just showed you, at just 3%, not the 8% that I was talking that happened the last time around, but simply at 3% appreciation, even though we have less than half the inventory that we had then, far less than half the inventory. Well, that would be $30,000 of appreciation in just the first year. Now, you did pay a higher rate. Absolutely. That had a cost. Let's call that cost $5,000. Okay, a higher rate, higher cost of $5,000 because you have to now refinance into a new loan. So there's let's say a $5,000 cost to having secured the higher rate, which makes your net gain $45,000. A $45,000 net gain. Again, the $20,000 that you were able to negotiate better, the $30,000 that the market gained, that's $50,000. But then you had a refinance fee of, let's call it $5,000. So you have benefited $45,000 economically for having taken advantage of a better time to negotiate because you accepted a temporary high rate that you then knew you could refinance later. Now, do I know that you could refinance it in 5 months, in 6 months, in a year, in 5 years? Of course not. I don't have the crystal. I don't claim to. This is just a hypothetical illustration. Your job is to decide, is that illustration more likely or less likely to happen in X amount of time? My theory, my belief is absolutely. And the reason why is all of what we've looked at. I wanted to give you some different data today, but we looked so closely at all the factors, the decreasing shelter costs, which make up about 41%, I believe it is, of the inflation reading. We have looked at the fact that recessions always create lower interest rates. We have looked at those high CPI numbers from a year ago falling off because it's a 12-month reading and getting replaced with lower rate readings. And so for all those reasons, I believe that refinance opportunity will be there, but it's your job to make the decision based on the data, not based on the news, not based on the scare tactics out there. So if you're looking to, by the way, to get an updated home value in under a minute, go to soldbydanbeer.com. You'll see in the middle of the screen, there'll be a bar. You put your address in, and without even talking to an agent, you will get an updated value, taking into account all current market condition. And it's a pretty cool tool. In fact, they were the radio on Kogo. They were talking about it there, how we've invested in the absolute best technology to give you a really streamlined experience. So if you want to get that updated home value, go there. If you have any questions, send them through. Send them to my email, which you're always welcome to do. And I give you my personal email that will reach me directly, info@beerhometeam.com. That'll hit my inbox direct, info@beerhometeam.com. I hope you found this valuable. You'll get the replay, and we will, of course, post it up on YouTube. If you want to go to YouTube, make sure you subscribe to our channel at SanDiegoNeighborhoods.com. If you're watching there, hit that button, tap the bell for notifications, and make sure you subscribe so you're always in the know of any changing market conditions here in San Diego. And we'll catch you on the next one.